Hello. Hello. Meeting started? Oh no, it didn't start.
Oi, Gabriel, tudo bem?
Hello. E aí?
Tudo
Quem é?
good, how are you?
Esse. Ana. Ana Gabriel.
Hi. Yeah,
Is it Gabrielle or Gabriela?
it's Gabrielle.
Gabrielle.
Yeah. There were already four Annas in my family when I was born, so my dad decided to be different and he named me Anne Gabrielle.
I like it.
Thank you. Okay, baby, I signed your folder. Good job on the 100. Of course, he decides to bring it to me minutes before the meeting starts.
Right? Yes, no, no, no.
Can you hear the music this time or no?
No.
I see the time, but I don't hear the music.
No music?
No music, but the time is there. The stopwatch is there.
What
Mom,
the heck? How did I do that before? I'm blasting music here. It's no good. I'm blasting the music here. It is absolutely no good. It's no good at all.
that's okay.
Darn, I gotta figure that out. It was a good dance song too.
We forgive you.
All's well.
We have to make sure that we stay awake. It's past my bedtime today. It's been a long, long day. How did you get a chance to rest yesterday?
Yes, we went to my mom's house for the 4-day weekend.
Yay! No
Lots
cooking,
of
no
swimming
cleaning.
for no cooking, no cleaning, lots of swimming for the little people.
That's good. Then somebody entertain these people, right? Somebody entertain these people.
Yes. I go, the grandchildren you asked for, here they are.
Yes, I can't wait. I can't wait. I'm gonna get there. I'm gonna get there one day. Oh, hi Mel. How are you?
For sure.
Tudo. Good, good. I don't know if Renato's gonna show up on this one over here. And if he doesn't show up on this phone call, I will go ahead and tell his story because that's what really helped me see exactly how this works. Okay. So I invited him to come because his story really emphasized the idea of uh, having liquidity in your assets, which to me it was a no-brainer. But when I started watching how when you put your money somewhere where it's non-liquid for you, what happens? And he went through that situation. So this is something that so I'm going to start because I want to honor your time, and we're going to talk today about how to reach uh, mortgage holders. Vast majority of people have mortgages. Very few people in the population have a home where they don't have a mortgage. The house is either passed down or they paid it off, or yes, oh, there he is. I'm so excited. So that it's not very many people that can say that they have a mortgage paid off, which means this is going to help a lot of people figure out what to do about their mortgage. And then it's going to teach people how to accelerate those payments. Hi, Renato. Thank you so much for being here. Thank you. I appreciate that.
Hey Anna,
I was just
how you
saying your
doing?
name. Um, and so the reason why we talk about this is because people don't realize that there's options, right? When people close their house, they just get a mortgage, they get their amortization schedule, and they say, "Yep, I'm stuck with this," until they sell again, or the rates go down and they start getting mailers saying, you know, refinance your home. This is the best time to refinance. But people don't really understand what's going on with their money. And because this is what you want to say and emphasize with anybody that you talk to about mortgages. just because you can afford the mortgage does not mean that's the best thing for you. Just because you can afford the monthly payments does not mean that this is the best scenario for you.
Right.
And so that's a question that you may want to ask. Instead, I choose not to tell people, but I choose to ask them questions because it gets them thinking about what they would say if they had to answer that question. So first question is, how is your mortgage a 10-year, I'm sorry, a 15-year or a 30-year fixed? That's the first question that I ask when we're talking about mortgages. You have a 30 or 15-year. And then people will tell you, why would a person choose normally a 15-year mortgage? What would be the reason to do that?
Pay faster.
Pay faster, right? They can
Save
afford it.
interest.
Say it again.
Save interest.
Save interest, right? So those are the reasons why you pay faster. The reason why you want to pay faster is not only to get rid of the payment, but also to pay less interest over time, right? So that's the reason why most people choose those things. But when you start putting in, so when people don't understand is that the APR that they're sold with their rate is not the same rate that they're paying of interest. They're not only paying the APR that is quoted at the closing of the mortgage.
Well, the APR, just to let you know, it's on the 29th year.
That's
That's
it.
that's the 4% or 3%. In the beginning of the mortgage, your first 7 to 10 years, it's between 78% to 75% of interest every month.
Wow.
You're going to equalize the principal with the interest at about the year 18 and a half. So 18 years of paying more interest than principal. And I'm going to show you some tools that you can have it for your clients. But I don't want
How do you
Hannah,
check that? How do you check that when you're talking to a client?
so I'm going to show it to you. I'm going to give you some tools that you can keep that. I'm going to put on the chat and I'm going to put on the family group, for GFF group, so everybody can have those links. But these are tools that you want to use as you're talking to the client. Now, the scenario for today is going to show options. Okay, so you want to have apples to apples when you show your client these options. So initially, when I start talking about this, I don't usually talk about Family Bank. I talk about your options, and this is one of the options. Okay, so I'm going to share my screen, and I want Renato, before I share my screen, Renato, would you just kind of go over the reason why I talk about mortgage is because of your story from 2009, the one that you share on your YouTube video. So if you could simplify that story and tell us why it's so important to have options when it comes to accelerating your mortgage payment.
Yeah, well, I'm a big believer in real estate. First of all, it's good investments for you to have, and there's nothing wrong for you to buy real estate, invest in real estate, create rentals or anything like that. So back in 2001, let's start in 2001, I had 5 properties, and those properties I had all of them rented out. I had a couple in Orlando, and the rest was here by between uh, Pompano and Boca. Okay, actually Pompano and North Lauderdale and Boca. So on those properties, I was told, and that's the person that sold me the homes, my real estate broker, or let's say my agent advised me to say, look, this is investments. You don't want to collect the money now, so you're gonna rent it out. You're gonna make a profit. Whatever it is, 300, 400, 500, whatever it is, put it into your principal. Just send it back. Make a difference check to the principal, because when you 50 when you are 50 years old, you're gonna have all these properties paid off. So I said, well, that's nice. That's I'm 50, I have 5 properties paid off. I'll be doing good. I can really retire, and then just wait for my Social Security. I don't need my Social Security. I said, I like that. That's a good idea. But remember, I was construction worker. All I knew how to do is go to work every morning and make money and give it to the mortgage companies. That's all I knew. Go to work every day like a robot. You go to work every day, work 10 hours a day, give a paycheck and get the rental here and give all the money out and left with no money. Pretty much no money. So I did that from 2001 to like 2000 or 2000 to 2007, 2008. That's when everything went down. Banks went bankrupt. So, and I'm thinking to myself, I say, okay, these people are gonna stop paying me. You know, my salary, got cut about 30%. So I couldn't afford, to pay the other homes, any other homes. And my tenants used to call me and say, Ron, I can only give you $300 a day or 500 for the rent. I'm like, what about the rest? I need the rest. So I used to get all that money together. On the end of the month, it was like $2,000, and I had 5 mortgages, and so I had to put money on my money from savings account on top of that to maintain the mortgage. Say, okay, something's gonna happen next month. Something's gonna happen next month. They're gonna have a job. They're gonna have money. They're gonna pay me the rent. So nothing happened. So one day I called each mortgage company and said, look, you know, I have all these houses mortgaged. They were paying me rent. I was giving you additional money to the principal. I gave you at least another $20,000, $30,000. Can you help me with these payments and so I can maintain my properties, my investments? And they said, I'm sorry, we can help you with one payment to put it to the end. I said, well, what about next month? The next month, I gave you 20,000. I said, I'm sorry, so yeah, you got to make your payment. So I decided to stop paying because I was going to go bankrupt, because I was using my money, my savings that I had. I had a little bit of savings. I said, well, I'll maintain it. But then, my ex-wife, actually it was my ex-wife, my ex-wife said, what are you doing? I mean, we're going to go broke with them, with everybody else. And I said, yeah, I need to stop. So, long story short, the banks went bankrupt. They helped all the banks, the government helped all the banks. There was a law called bailout. They bailed out all the banks. They gave them money. The banks took my money, all my actually it was $121,000 that I between all 5 mortgages that I gave it to them. $121,000. Okay, remember that number, 120. Just remember 120,000. They sold my house, went on short sale. They sold everything for cash. One of my houses I had was worth of 480,000. They sold for 180. Right, 180 in Boca Raton, beautiful home with a pool. 180. They took money from me for now another 30,000, plus all those years that I was paying the mortgage, all those 7 years. So they kept all my money, and then the houses in Pompano, by the ones I had, went down to $40,000. And I was keep thinking to myself, I said, what, if I had the $120,000 with me, if I had saved that somewhere under the mattress, it didn't have to be life insurance or any product, nowhere, just under my mattress, I would have been able to buy 3 homes, cash, no mortgage, paid off. And today, each of those homes are between $2,500 to $3,000 a month in rental. So that's why I told you to remember that 120,000. That $120,000 got out of my hand, got out of control. They had control of my money. They had control of my life. They had control of my financial, and 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 that's why we don't teach these no more. And that's why, you know, I tell people learn from my mistakes. That was a mistake. I didn't know any better. But today, there are people out there, real estate agents, that are advising their clients to do this, to send additional money to the principal. And there's a lot of people doing it. They think nothing's going to happen, you know. So not only mortgage, they send additional money to the cars, they send additional money to credit cards, they send additional money, and then on the end of the month, they have nothing, and they still have the debt. That's my story.
Thank you. Thanks.
So sad, right? Don't cry, Anna.
Well, well, it's a good learning tool for us. I thank you for sharing that, Renato, because a lot of people don't want to talk about that. You know, that's something that happened to them. They're like, okay, I'm not telling anybody.
Yeah,
It's
and
good.
back in
But
2018, Global News came. They heard about my story, and there's another thousands of people that happened. The
same thing.
same thing happened. Today they don't do it no more. They're done with that. But they don't talk about. They don't want to talk about.
But in this economy, thank you, Renato, for sharing. This economy that we are right now, we are on the brink of a lot of people going through the same thing that Renato had happened, because mortgages are so expensive. Economy is not gonna get any better. You know, the prediction in the real estate, correct me if I'm wrong, well, it's predictions, but I do predict that
2024?
next year is election year. So I do believe the rates are going to go down. So if you can buy real estate today, buy real estate today, even if the rates are high, because you can always refinance, but the houses are stable in price right now. And the house that today is worth 500,000 next year is going to be a lot more, because there's no inventory. And next year, when the rates go down, everybody's going to want to buy a house. There's no houses. You can put, there's going to be another bubble. And this is my prediction being in real estate. There's not enough inventory in the area that we're right now, and the rates are super high. So when the rates lower, people are going to be interested in real estate. There's not going to be enough houses to buy. So there's going to be a bidding war for houses. So if you have real estate right now and you buy it, even as a high rate, you can sell it later. You can actually be you can
I'm
actually
selling
be,
mine for 1.2 if you want to list it.
awesome. Do you know what I want to do? I'm going to buy a few more, and this is what we're going to do next year. We're going to be the bank. I'm going to do seller finance.
Yeah.
Imagine that. Do seller finance. I'll do a 30-year mortgage for you at lower than what the banks are going to offer. You don't have to, I mean, you
Yeah.
rent to own, pretty much. Rent to own.
Rent on. Yeah. And
It's the
hold the
best
mortgage.
deal. Yeah. They can pay the mortgage. I'll keep the cash flow. If they default, the house is still mine. Who wants to buy? That's
Yeah. And then if people say, well, you're crazy not to pay more on your credit card every month. And they say, yes, you are crazy if you don't have a plan.
yeah.
Okay? If you don't have a plan, you are crazy just to pay the minimum. You are
You don't,
crazy.
yeah, you don't have a table. You don't have an end to that. You don't have an end to that. You are just paying over, but you don't have an end to that debt. You continue to pay interest. You're
So
continuing to
that's
pay the interest.
right. So that's why you get the additional money that you are sending, then you put it into a plan where you're going to pay it off.
So this is what I want to share. Thank you, Renato, for being here. If you are busy and you need to take care of your son, we're gonna do this again in Portuguese, and I'll come. You know, you can. But I'm gonna share the same exact tools from this
That's
from
good.
the next one.
I'm gonna go then. Are you doing the amortization schedule? That's good.
I'm gonna do, so I'm gonna show an amortization schedule, what it looks like, and then I'm gonna show the PDF file so people can have it. And then I'm gonna
Yes.
do a mortgage payoff calculator. So if a person were to pay off two mortgages, you know, one at the first of the month and one at the 15th of the month, show them how much they would save and how many years they would save. And then I'm gonna go ahead and I'm gonna show them. There's a guy that I follow that is super good on YouTube. I'm going to show them this channel so they can follow, because he really breaks down. I don't have 3 hours to show breaking down of monthly payments, APR, things like that. So You can look at his videos, but then I'm going to show what it looks like if you were to follow our plan and how many years and how much money you would save. So I have the same exact plan, you know, paying 2 mortgages at the same time. So how much money you would, it's just the house here. So I have that plan, and then I'll have the tools where to find it. If you go to my website, into the mortgage calculator website, like this is all the tools are there on my website. So this is what I'm going to show today.
Okay, sounds
Okay.
good. Okay, if I'm still awake, I go to the 9 o'clock.
That's gonna be the Portuguese. If you're not there, I'll share your story. Thank you. I appreciate you coming
Bye,
by.
all right, Gabriel.
Bye.
Later.
Thank you, Renato.
You're welcome. Bye-bye.
Okay, so the first tool that I want to share with you, and I'm gonna send this on the chat. This is already I calculated this already to make life easy for us for the class today. But I'm gonna do average, okay, a 300,000 mortgage in a 30-year. So the home price here shows 325, and then you put in the $25,000 down, because on this calculator you got to put something down. And I'm just doing a very, very nice 6% interest. This is what people with excellent credit are getting right now, 6.5, 6.7, so it depends. 30-year mortgage, and then I want to show the amortization schedule monthly. So what is an amortization schedule? You get this when you close on a house, but it shows how. So the payment is a fixed payment. So every month, this person will pay $1,798.65 for 30 years, so 360 payments. The house, the loan is $300,000. And at the end of the 30 years, they'll be paying $347,000 in interest. So the actual interest paid on a 6% rate is more than double of what the loan is. So they're paying more in interest than in an actual house. So far, so
That's way
good?
too high. My God.
Yeah. So it's not 6% simple interest on a one-time thing. Okay. So the
Crazy.
interest is calculated yearly on top of what is owed at the end. So, and actually it's calculated every month, right? Because you make a monthly payment. So 6% on the balance owed on that month. That's why it becomes that much. So just curiosity, when you want to show this a little bit more in depth to your clients, this is what you can do. You can say, okay, it says 6% interest, but it's not calculated on the 300,000. It is calculated every month on what you owe as the balance. So how do you know how much you're actually paying? Get a calculator and go here with me. Do 1790. I'm sorry. You're going to be doing the opposite. You're going to be doing the principal here on the first payment, $298.65. So $298.65 is what you're paying on principal, $298.65. I'm doing it with you. And then you divide it by the amount paid. So $1,798.65. And then you can see the percentage that you're charged, 16%. 16% of your amount paid is going towards your principal. The remainder is going to your interest. So it's not 6%. Do you see that?
Mm-hmm.
Okay. So just to remember, when we talk about 6%, when we in any other bill that we talk about, 6% would be you get an amount, you do it times 6%, and that's the amount, right? So if you were to get a $300,000 house and you say I'm paying 6%, you're not paying $18,000 in interest on this house. Does it make sense? That's what people would say, because it's over 30 years and the interest is calculated monthly on top of the principal balance that is, I'm sorry, on the balance that remains every single month. That's how you calculate. That's why you're paying more than the house itself in interest. Okay. So there is a benefit to loaning the money. If you want to buy a house and you don't have the money, you got to find somebody that loans you the money. So, you have options. The bank is one option, but there's many, many more options. let me just show you what a amortization schedule looks like. So here, this is the very first payment. They're paying $17.98 for the life of the loan. So for the 30 years, so the 360 payments. Here's the last payment. Oh,
My
I get it.
God, doesn't stop.
No, all right. So on the last payment, they're still paying $8.95 in interest there. The last payment still has interest to be paid 30 years after. Okay. But so how do you do this? So the first one is $298 and then interest is $1,500. So it from the $17.98, it only went down $298 for the balance that you have. And so, you're paying this forever. Principal, when you get to year 18, that's when you're going to start seeing pretty much leveled off. Year 18 here.
Why is it getting higher?
Where is it getting higher?
The go up the interest, right?
Sure. So the
Yeah, the
principal,
principal paid. Okay, that's okay.
so it's going to start leveling off. So you're going to be
Yeah.
paying more principal, less interest over time, right? So more principal, less interest. So like I said to you, when you get to about the $800 here, what did I see? $899. So here, payment 222. So 222 divided by 12, that's 18 and a half. That's pretty much every single mortgage is pretty much like that. Year 18 and a half. That's when you are averaging same, and then it's going to start going more interest, more principal, less interest until you get to the very last. Okay. So this is an amortization schedule. When you show this to a client and they don't see this, people don't realize how much interest and principal they're paying. And so this is what happens. You buy a house, for the first 18 years of that loan, you're paying more interest than principal, right? So when you pay 18 years, let's say that you stay in the house for 7 years. So what is 7 times 12? Payment 84. Then you go sell that house and you go, I bought this house for 300,000. Man, I've accumulated a lot of equity here, right? And then you go to sell it, it's 268. You're like, wait, 10 years payments and I only went down 30,000 on this. What is wrong with this picture? Think about that for a minute, right? Because you've only paid a little bit of principal. And so what happens is the vast majority of families, the greatest majority of the families, they move. Very little people stay in their home for 30 years. So you really don't, you never pay. And who gains from this process of purchase, refinance, or purchase, resell, purchase? The house is the same. My house here, 11299, like we're in the same house, right? So if I stay in this house, we actually purchased this house in 2019. If I stay in this house for 10 years and then I sell it, the bank has received 10 years of interest on this house. The next family that comes over does the same process. The bank will collect the next 10 years of interest. The house never really belongs to anybody. We just pay down interest, but it belongs to the bank the whole time. We are the fourth owner of this house. There's 3 families that lived here before us. Those 3 families did the same exact thing. The bank has received interest from every single family that has lived over here. The house is never paid off. So they're getting, and the next family, if we sell this house, same thing. The banks collect the interest forever and ever on that same asset. There's no building. We could put in a wall here, whatever, but the bank didn't do any improvements. I did improvements. I will pay, and I'll probably loan money to pay for the improvements, right? So that's how amortization works, and that's how loans work. Okay, so I wanted to show you. So here is the PDF file of the same amortization, right? So the number of payments, you get the point. So this is exactly what I was just showing you over there. I'm going to close this off because there's no need to do that. So let's say that you're talking to somebody and they say, I really would like to eliminate as much of that percentage that I'm paying in interest. I don't want to pay that much. I want to keep that in my pocket. How do I do that? What are the tools that you hear online, or when you hear people say, what do people say about paying off their mortgage early? What do you see?
Saving money on interest.
Yeah, but how do you, what are the tools that they're provided? So what are the things that
Make
people
2
say?
payments a month.
Make 2 payments a month, right?
Uh,
Right. If you can afford it, right? The mortgage is already expensive, but you can afford a second payment. Go ahead and do that. That's what Renato said it, right? Renato said the same thing. You just go ahead and pay one extra payment, pay a little bit more. Let's switch gears and talk about credit cards. It's the same thing, right? I have a credit card debt. I'm gonna pay a little bit more every month. How many people you hear saying the same thing? I want to pay a little bit more, right? So most people do that. They put the money in the bank's hand,
mhm.
right? Okay. So I do have, let me see if I can show you. Let me see here real quick. Yeah, I'm gonna show you this. So I'm sorry, where are you at? This is something that you're gonna see this a lot with your clients. You're always encouraged to pay a little bit more. And I said this to the guy that we went to buy a car for my mom, and he was his young kid and says, I'm gonna buy my first house, and yeah, I'm gonna pay it off fast, and I'm gonna put a little bit more there. This is mortgage payment portal, okay? And it's here, the mortgage is low because I
What is the
don't.
difference between this page and the other page?
So this is an actual loan. This is the loan. This is an actual loan for a house.
Oh,
This is
you
just
apply
a
for the loan?
pretend one. Yeah, this is just a pretend loan. Okay.
Okay.
I just created this loan. But over here, you don't have the options of the payments. I'm just calculating this just for the fun of it. This
Mhm.
over here is an actual loan. Okay. So this house, the mortgage is super low because the escrow is removed. So it's just the house and the interest. There's no taxes and there's no insurance in here. And that's a good way to do that. So every time you see a loan like this, you're always going to have the additional principal window. They always encouraged you, put a little bit more, pay a little bit more. Look, I even have a calculator here that shows, look, if you pay this much more, you're going to save this much, and you're going to in interest, and you're going to shave this much off in time frame. Every mortgage company will offer you, pay a little bit more, do a lump sum, erase a little bit more the interest that you're paying. If I put over here, I'm gonna put in 15,000. Okay, I got tax return. I'm gonna save this much in interest, and I'm gonna pay my loan off in 3 years. It's so easy. It's right there for you, right? So
Mhm.
So the question that I asked the gentleman, he says, I'm going to be paying off, I'm going to be paying second payment every month. And I said to him, have you ever thought about how do the banks make money when they loan you money for a mortgage?
They invested.
Right. They take the money that you pay them and they invest it. And you're paying double the house, right? So you're paying a $300,000 mortgage, but you're paying $345 on a mortgage, right? On a good rate, 6%. Okay. So they're making money on interest. So it would be counterproductive for them to really offer you to pay it off earlier, wouldn't you say?
Mm-hmm.
Yes.
So the banks are all about making money. They're not for social work, right? They're there to make money. They make money when you extend the loan. They make money when you refinance the loan. And yet, on their portal, it has an option for you to do the complete opposite of what they want.
Yeah,
Have you
that's what I was thinking.
thought about it? Yeah, so let's think about this for a little bit. Let's think logically, right? Because the banks want to make money. They make money when you extend your loan, but in their portal, it's offering you to pay early. Why is that?
Because you're paying off interest. You're not actually paying off the loan.
Now it's telling you that you can, on the thing, it says, go ahead and put it in here and we'll apply it towards the principal. It says right there, lump sum can signify long-term savings. So over here would be like here, additional principal. So they will apply it to the principal alone, which would lower the interest paid to them. This is an accurate representation of what is going to happen. So if I put 15,000 in there, it's going to lower the interest that is giving to them. So in fact, they are losing here. So if they're losing and they're putting that in why would they do that? Why would banks offer you an opportunity for you to win over them? Why would they give you that option?
Can I guess?
Yeah,
Because not most people stay in the same house after 30 years, so they won't actually finish paying off all their things.
exactly.
Is that it?
Exactly. Yeah. So that's exactly the point. Give me more money. Let me have control. You will never get to the three last, because this is not going to be applied to the next payment. It's going to be applied to the end of the loan, correct?
End of the loan.
Correct. So now you are putting that money, just like happened to Renato. You're giving them the money. You're releasing control over that money. You're giving them. They're not going to put that money in a little box with your
Mhm.
name on it, waiting for that payment. What are they? They're going to be investing that money, right?
Yeah.
And if you ever miss a payment, they don't care. They're still going to need to collect. So you're going to lose that money. So as much money as you give them above your mortgage, they win.
But I got a question on that.
Yes, sir.
Okay.
Mhm.
So if I get a house for 100,000 and I pay off 50,000
Okay.
in principal, and now I have 50,000 remaining, but I go and sell the house for 200,000, that 200,000 will take away 50 to pay off the house, and I keep 150.
Correct. Keep 100, right? So if you sell it for 200,
Yeah, I sell it for 200. I pay off,
the 50 that you
50.
still owe,
and I still have 150.
100.
150. I gained 200, but I take off 50 because I owe 50.
So
200 plus 50 is 150.
He already paid off 50 and now he sold the house.
you're buying a house for 100, right?
Yeah.
So you put a down payment of 50, correct?
Okay.
Okay. So you actually just have a loan for 50,000,
Yeah.
correct? The other 50 is gone. You're not going
Yeah.
to see that again, right?
Correct.
So the original 50 is gone. You owe 50. Then you sell that house for 200.
Yeah.
So then you're gonna get out of the 200 that the bank will pay you. They don't give you the money. They will pay off the first. There's gonna be 150 left over.
Yeah, that's what I said.
Okay, correct.
Okay,
Yeah.
just making sure.
Yes, correct. Yeah, you are correct. Okay, so is that what you wanted to hear?
Yeah, yeah. I'm just curious.
Yes.
I don't know if
'Cause,
there's something else on that.
right. So every time a person buys and sells a house, that's what happens. If you are in a home and I still owe money, the buyer of the house is going to be paying me more, hopefully, right? I'm not going to be upside down on my loan. So the buyer of the home is going to be paying me more. The mortgage company is going to pay the title company. The title company pays off my old loan, and the remainder is my profits.
Mm-hmm.
So that's how resale works. Okay, if you don't have a mortgage, that's great because it's all the money is for you. But if you do owe money, let's pay that off first. If you have liens on it, if you have a HELOC, if you have a second mortgage, those have to be all paid off before you can write the title to the new owner. Otherwise, you can't.
Can you talk more on HELOC and liens?
Right. Okay. So liens are bills that are yet to be paid. So if you had a contractor come over to your house and put a pool in it or a roof, and you forgot to pay the bill, or you intentionally didn't pay the bill, the contractor can put a lien on your house. They can put a bill that is due in the county. And so when you go sell that house, they say, no, part of that profit that Gabriel's going to have in the house is mine. He needs to pay me for that pool.
Yeah.
Or if you have a loan in a bank or something and they decide to put a lien against your property. So that's a lien.
That makes sense.
Okay. Now in a HELOC or there's type. So if you have a house that you bought for 100,000 and now it's valued at 500,000. You have 400,000 in equity on that house, right?
Mhm.
And so it's equity, it's value, but it's not liquid to you. Like if you need money to buy a car, you can't sell the
Yeah.
house to. So what do? You make a loan against that money that eventually is liquid to you. So you borrow from the equity of your house. It's called home equity line of credit. So it's like you take out a loan against your own house. Your house is yours, it's already valued. So now you can pull out some of that money and buy that car for yourself with that money. But then now you have a second bill, which is the amount of money for the HELOC. Does that make sense? So now you pay for your
You lost me
mortgage.
in the second half.
Okay. So let's say that my mortgage is $1,000
Mm-hmm.
and I have 400 in equity. I take another $100,000 in a HELOC. I borrow 100,000
Okay.
out of those 400. So now that 100,000 that I borrowed against, I have to pay back. It's
Mm-hmm.
another loan. So it's a second loan or a HELOC or whatever you
Yeah.
want to call it, second mortgage. So
Mm-hmm.
now my payment is not going to be only 1,000. I have to pay 1,000 plus the HELOC bill, which is
Yeah.
going to be whatever, you have to qualify for that. So now monthly, I have two bills. I have the original bill and I have the HELOC bill that I have to pay monthly. There are some mortgages that are called reverse mortgages that you can take that loan against, and it's only due when you sell the house. So you don't have to pay that. But when you do sell the house, that's going to come due and you have to pay for that.
Mm.
Okay.
Oh, I've seen a
It
lot of
exists.
commercials for elderly people advising them to do that.
Right. So, if you
But
want the
then when your
money now,
kids go to sell your house, then you have to pay all that back.
you have to pay that back, but you advance now. So you're now advancing that liquidity that you'd have when you die, or when you no longer can live by yourself, and now your kids are trying to sell the house. So you do have all the liquidity. You have all that money that's accumulated over the years on your property that you still can't you can't hold it yet. So it's a reputable business. It's okay. It costs money to do that because you're advancing your money, but you can use that. It's a decent way to liquidate your assets. Okay? It's okay.
My cousin, he did the first home how you say?
Lean.
Not
Lean?
lean, the other one. HEVOC?
HELOC.
HELOC. Hinata was talking to him for like 3 hours. Man, it took forever, and they were just talking back and forth, and I didn't know what these was. But for some reason, he still didn't go for it. I don't know why. I don't get it. I get what you mean now, but I don't understand why he would prefer HELOC over, having your own bank.
Because a HELOC is, if you don't have the bank, you don't have anything. If you haven't funded your bank, you don't have any money to put in the bank. I mean, you have to put money out. So if I have not funded my own family bank, a HELOC, I can pull out the money.
Yeah.
The
Whenever.
family bank, if you haven't funded, there's nothing to pull out of.
Yeah.
Okay, so here's an example. I took a
see.
HELOC to buy an investment property.
Mhm.
So my house in Missouri has a lot of equity there. We bought it 13 years ago, and I wanted to buy another one. So I took money out of that house to use it as a down payment on another house. I almost owe nothing on that house. So my mortgage there is ridiculous. And I have a tenant there. So the tenant is paying for my mortgage there.
Yeah.
But I took the HELOC at a very low rate when the rates are great and use that money to put down on another property. So now that second property is low in mortgage because I put a sizable down payment on it. Does that make sense?
Yeah.
So my tenant is paying for my HELOC and my new mortgage is very low.
Perfect.
Does it make sense?
Yeah.
Okay.
Yeah.
So money is not coming out of my pocket. One asset is making another asset happen.
Yeah.
Does that make sense? Okay, so money's making money. That's exactly what I want my money to do. Instead of just sitting there waiting for me to sell it, I may never sell that house, but I want to use the money that accumulated there over time. Okay, so that's what a HELOC can do for you. Now, HELOCs could go bad if the rate is too high and it goes above your debt to income ratio. So now you're struggling to pay the HELOC. So you got to be.
Yeah. What if the market goes down and you don't have any more, You know what I mean? Like,
Value on the house.
yeah, if you
What-
don't have any more value.
Once you pull it, you pull it. It's liquidity. You once you pull the money, you pull the money. It's your money.
Okay, but I'm saying like if you have a HELOC on the house and the house was 100, but now it's 500, you made 400,000, you take out the $400,000 as an investment, you spend the money, whatever. But now the market went down, your house is not worth 400 anymore, it's worth 80. So do
As
you
long,
owe them 400?
no, because as long as that mortgage is still valid, when you pulled out that HELOC, your budget was allowing for that. So if that house has a renter on it and the renter is still paying their rent, the mortgage on that original house is still the same. The HELOC is still the same.
Okay.
If you were to want to sell that house when the market is down and you lost value, you wouldn't have enough money to pay for those two loans. But that would be it would be a decision that you have to make. Do you have to sell that property? Otherwise, you hold the property until the market goes back up again.
Okay.
But the situation with the payments is the same because you either are accustomed to that mortgage and the HELOC already when you took it
Yeah.
out, or you already have a tenant there that's already paying you that value, and those bills are paid for already.
Gotcha.
The value of your asset is only going to weigh on you if you sell it when it's low, just like the stock market. When you invest on something when the market is low and then it grows, that's when you sell. You don't wait till market to go down to sell it. So you wouldn't
Yeah.
sell that asset until the market goes back up again. So you hold the asset until it goes back up again, evaluates. That's it. Make sense?
So
Yeah.
if you have a HELOC, can you use that money to buy another property and avoid inheritance tax, which I don't even know how much that is?
Okay,
Or
the easier way to avoid an inheritance tax is to open a trust and move all of your assets into a trust. You do not have to, you don't have your beneficiaries don't pay inheritance tax if your assets are inside of a trust.
then can I still sell the property after I put it in the trust? Because
Yes.
I have this property, but I don't know how much the inheritance tax would be.
So
after I
there's no
put-
inheritance tax as long as you open a trust, change the deed and the title to the ownership of the trust. When you sell it as a trust asset. And then the profit and the gains are a profit of the trust. The trust does not owe taxes.
Okay, and then I use the money in the trust to buy the other house.
Not
And
buy
then I
another
put
house.
that in the trust.
Correct.
I need to learn how to open a trust. Okay.
Send me a message. I'll send you a guy. Okay. So let's go back to what we were talking about. So far, so good?
So far, so good.
Yes. Okay. So the reason why they want you to pay more money is because they keep the money. They use the money to their end, right? And then you don't have control of the money, which is not what you want. You want to have control of the money. You want to have that money is yours. And that's the whole point of why I appreciated Renato to come to the phone call, because he exemplified this point exactly. So let's go. Here's a mortgage payoff calendar. So calculator, how do you get to this? You go to annafarrell.com. You go to my website, you go to real estate, and then you click on mortgage calculator. This is a regular mortgage calculator, but this is not what I want. I want to go to extra payments. So if a person says to you, oh, I want to buy a house and I want to make extra payments a month, this is how it would show how much the benefit would be for an extra payment. So before the class started, I already did that. So we're going to go through the same exact scenario. Okay. So it's a 30-year mortgage, 6%, $300,000 house. I put it in there already. And so the payment is $1,798.25. So it rounds up to the next one. But then I'm also making a second payment. So additional payment. So 2 payments a month, just like we had talked about, right? So the payments on a monthly basis would be $35.98. The scheduled payments are these, the accelerated payments are these. So the client here in this case is saving $258,000 by making a second payment a month. Do you see that?
Mm-hmm.
And out of the 30 years, he's shaving off 20 years. So he's going to be paying that house off in 9 years and 1 month. If he was to do it regularly with his bank. So far, so good?
Yes.
You follow me? Okay. So let's make this small. And so then you have, so you can do this with your client. You can show them. So again, interest is 1,500. The principal is whatever. So you're paying very little here, right? So it's this the $298 is going to go to, so it shows again, the accelerated payment schedule here for what it would be. So when you get to payment number 109, which is 9 years and 1 month, you're making your very last payment. 291 is towards interest, 584 in principal, and this is it. You're done. There's no more house payment here. So in 9 years, okay? So this is making 2 payments in 1 month. So I would say to you, great, except that for the full 9 years, if anything were to happen in the case of Renato, and in the American market, if you look at real estate markets, it's a 10-year deal, up and down, 10 years, down 10 years, up 10 years, down 10 years. So the peaks are a 10-year spread consistently. So every 10 years, there's a boom, and then every 10 years, there's a crash. So this mortgage payoff puts this client on that 10-year bracket, 9 years, which it would be if there's any dip on the market or bubble on the market, they are liable for any kind of mess that could happen. If they lose a job, if the market crashes, if there's a war, if his property loses value, any of that is here. And he's not going to have a way out because his money is double in this product, which is there, not in a box with his name on it. They're investing it. So option B would be for them to use something like We Teach, which is having your banking. So instead of giving it to the bank, we're going to put it in his bank, right? I want to send you, there's a guy online, I think I mentioned that at the beginning. I love this guy, Javier Verdana. He's a real estate agent, but he's got a lot of videos that are very detail oriented. Oh my gosh, he just goes on. And he really breaks down. He's got lots of good videos that break down rates and how to calculate things. And if you were to buy down points and all that kinds of stuff. So I sent you his website. I was strongly suggest follow him because he is really very knowledgeable, and he breaks it down to people that have never heard of any terms. He just goes down way down to zero and breaks it down for everybody. I like him. So follow him. All right. So I created a mortgage acceleration scenario, okay, where in this situation, a client has 30-year mortgage. So let's go back over there. 30-year mortgage, 360 payments, 6%, 300,000. And here's the see every time you put in the data, the same amount shows up, which means everybody's got the same thing. And the payments would be 647, which would be 347 in interest. So far, we're in the same. So it's apples with apples. We're comparing apples to apples. Here it is again, more visual. And so if you were to follow the Family Bank style, it would not be 9 years and 1 month. It would be 12 years and 9 months. And you are saving, instead of saving 258,000 in savings, with the Family Bank, you are saving 209 in savings. So 258 and 209. So, and then over here, you would have the show that you on year 2036, 13th year, you'd be paying off that mortgage. So then as a agent, right? As an agent, so I showed you where to find that information. So as an agent, I'm talking to my client and he's saying, I will be paying off those instead of, I could be saving it's money wise for me, it's best to go ahead and do the second payment mortgage wise, right? Correct so far? Yeah, it's a better scenario for me to make the second payment. And so then I have to go back to the original conversation that we had of the story of Renato. And that's where you want to have multiple points. Benjamin Franklin used to, when he needed to make a decision, he used to split the page in half and put pros and cons and and then make a list of the pros and cons. And so I did that for us today. I did that for us because I wanted to make sure that we are able to show everybody what is the most important part of this scenario. It is saving money. Yes, it's important for us to know how to teach our clients how to save money. Yes, but what are the pros and the cons? And when you come to the pros and the cons, you realize that there's more to it than just the saving the money. Number one is the liquidity. When your client understands that if they lose access to that money and it's not in their possession, doesn't matter if they broke a leg, lost whatever, they still have to make those payments and they have nothing to fulfill those obligations. Now you're in a position of losing your assets that you have put in 2 years, 3 years, 5 years, 10 years worth of payments there. So the liquidity, money in your hands, having control. And Renato in his beginning, he said the word control a few times. So you have control of your money when you put in on your family bank. The second one is protection.
Yeah.
When you have your family bank, you have your protection. If anything were to happen to you, somebody is making your mortgage payments for you. Right? Because when you have your family bank, you are protected with critical, chronic, and terminal illnesses. And the bank is not going to give you that. It doesn't matter to them that you're critically injured, chronically, terminally injured. Doesn't matter to them. They want their money. And when you do something like the family bank, instead of is a generational wealth that we teach our clients. We not only want to keep these assets for myself, but I want to pass it down to my family. And when you don't have a family bank, you're purchasing that property, you're having the gains that you have to pay taxes on, you have inheritance tax that you have to worry about. And if you lose something, if you lose that asset, your kids don't receive any of that. You worked so hard to have an asset, but your kids will never see the benefit of that hard work of yours. And so when you put those, at least those three, there's more, but at least we're not talking about emotional peace of mind, emotional stability that you pass on to your kids. When you have a parent that is working their tail off, they're always paying their bills, and that's all they're doing. They're not creating that wealth generation. Kids will grow up in that environment. They'll repeat that environment. So we're not even talking about that cycle. We're just talking about the very basic main points of creating that scenario where you have liquidity, you have protection, and you're creating generational wealth. People work because they want to not only enjoy it now, but they want to be able to enjoy it later, either in life or pass it down to their next generation. And these are the things that we want to discuss with our clients when we talk about these options that are available to them. So paying off a second payment is a great idea. Paying off a little bit more every month is a great idea. As long as you have control of that money, as long as that money is creating for you many other benefits beyond just that second payment that allows you to save on interest. Any questions, anything to add?
If I tell them to pay, if I talk to them about convincing them to pay an extra payment every month, like you just said, then why would they choose to do your family? I know your pros and cons. I saw that, but I also saw that they were saving more by paying extra every month than doing just your family bank.
And that's a choice that they have. I would always go back as to if the client asks me, why would I choose to pay more when my original question to you was to accelerate my payment, to avoid paying more interest and doing it faster? I would say, yes, you could do that. You could totally just do the second payment. That is up to you. You have to remember that when you're doing that, that is not the optimal solution for you. It is the optimal solution for the bank. The bank gains with that. You will lose, you will diminish the interest, but you're also losing power over that money. You're also, oi, Márcia. Oi, Márcia, tudo bom? Fica aqui, eu vou começar daqui 2 minutos em português, tá? Fica aqui só um pouquinho. A gente vai acabar de inglês só um minutinho, ok? Does that make sense? So that's what I would say. I would say, do it. That's okay. Just remember that there's no
Can you go
protection.
back 30 seconds? Can you say you will lose? You stop there.
So you lose control over the money, liquidity. You will lose any kind of protection. There's no protection for that money because once you relinquish power over that money, that is their money. It's no longer your money. And there's no generational wealth being built in that process.
Yeah, that's good.
So
And-
you just have to weigh it. So it is an option and you can continue with your option. I just showed you that you can. There is a better way to do it. You can still diminish a lot of the interest that you're going to pay. You can diminish a lot of the years that you're going to be paying that interest, but you can gain so much more. I mean, there's a plethora of benefits that are attached to the second option, but you do have the options. And at the end of the day, who's going to pay the next, you're going to be the paying partner there. I'm just here to show you there's options.
Yeah.
And you can fit that on credit card, on car, on personal loans, on student loans. You can fit it with everything. We
I would
just
like
did,
to hear more about student loans next meeting
yes, sir. Yes, sir.
Okay.
We'll do that.
because
We'll
the people my age are all students.
Everybody has student loans. Yep, exactly.
So I have a lot of friends who they don't think about retirement, but they will think about student loans.
Student loans are with you forever. Not even a bankruptcy can erase student
No,
loans.
but I'm just saying, like me, my age, the people my age, they won't think about retirement. They don't think about investment for the future. That's what I've been struggling with.
I
telling them.
got you.
But
one
if
day
I
you're gonna
mention
want to.
student loan, that's like a sensitivity on them.
Yeah, true. That's a good point. That's a pain point. That's a pain point. You're right.
So
I have a friend whose daughter is 38 and she's still paying off her daughter's students.
Yeah, that happens. We need to talk about student loans. That's a good point. Yeah. Okay. We'll do that next week. Thank you for giving me the topic. That's awesome. Okay. I'm going to shut this off and come back in English and Portuguese. Okay. All right.
Okay.
Very, very good. Thank you guys. I
Well,
appreciate that.
have a good one.
Marcia, eu vou